So now we'll prepare our schedule of cost of goods sold using that same basic formula that we see over and over again in accounting. And this time the formula is going to look a little bit different since we're dealing with a manufacturing company. So if this were a retailing company, we would be adding the cost of purchases to our beginning inventory, but we're not buying our inventory, we're making it ourselves. So let's take a look at how we'll prepare this schedule. We'll begin with our finished goods inventory that we had at the beginning of the period, and these are the unsold goods from the end of last period. Then we add the cost of the new finished goods that we finished manufacturing this period. And this number came from the final number in our schedule of cost of goods manufactured. So we made this many new finished goods. We had this many finished goods to start the period with. So we had a total of this amount available for sale. And these costs, they had to go somewhere. $9,500 is still sitting in ending finished goods inventory. This $9,500 represents the ending finished goods we have not sold yet. So if we subtract the ending finished goods from all the goods we had available for sale during the period, the difference must represent the cost of goods that we sold. But we're not quite done because we have to deal with the manufacturing overhead account. We have to look to see, did we apply too little overhead to our jobs or too much? So looking over here at the manufacturing overhead account, we see it has an ending debit balance of $13,900. That means we applied too little overhead to jobs. I know that because the total of these debits, the total actual manufacturing overhead costs, that total is $102,700. Yet we only applied $88,800 to our job cost sheets. So we underapplied by $13,900. The difference between the total debits and our credit. We can't just leave that balance in there. The manufacturing overhead account is a clearing account, and we need to close it to zero. And so therefore, what we'll do is transfer the underapplied overhead into cost of goods sold, and we'll reflect that here in our schedule. Because we did not apply enough overhead to our products, we're going to add the underapplied amount to cost of goods sold to get to our final adjusted cost of goods sold figure. And it's this figure, the adjusted cost of goods sold, that will go onto our income statement.